Tokenization of real-world assets. Imagine a world where the walls of finance begin to crumble, where ownership is no longer locked behind closed doors of billion-dollar institutions, hedge funds, and private banking clubs. Imagine if wealth in all its forms, buildings, land, stocks, bonds, commodities, even art, could flow as easily as a text message across borders. That world is not science fiction. It's the inevitable result of tokenization. Right now, trillions of dollars sit trapped in illiquid assets, real estate that takes months to sell, private equity locked up for years, bonds and securities traded only by insiders with access to the right brokers and clearinghouses. The very structure of traditional finance is built on bottlenecks, gatekeepers, and rules that slow the flow of capital. But blockchain technology has introduced a new idea. What if every asset in the world could be digitized into tokens, broken down into fractions and exchanged instantly on global networks? This concept, tokenization of real-world assets, is more than just a buzzword. It represents a tectonic shift in how money, value, and ownership will move in the digital age. And if history is any guide, the first movers in this revolution will capture extraordinary opportunities, while those who hesitate risk being left behind. Think about what happened when the internet digitized information. Newspapers collapsed, streaming platforms dethroned Hollywood giants, and online commerce disrupted retail across the globe. Tokenization is the same kind of disruptor. But instead of transforming media and shopping, it's rewriting the DNA of finance itself. In this story, we'll peel back the layers of what tokenization really means. We'll explore how it creates liquidity where none existed, how it enables markets that run 24 hours a day, how it tears down barriers to investment, and how it forces governments, regulators, and even central banks to adapt. This isn't just a technical evolution, it's a global financial revolution. Over the next 5 chapters, we'll dive deep into the mechanics and the meaning of this shift. First, the liquidity revolution, how fractional ownership in secondary markets will unlock trillions in dormant capital. Then, the rise of 24/7 global markets where assets move with the speed of light and without borders. We'll uncover how tokenization leads to democratization and inclusion, letting small investors participate in opportunities once reserved for the wealthy elite. We'll break down the importance of transparency and regulation, and why trust in the system may actually grow stronger when it's built on blockchain rails. And finally, we'll look at the macro impact, the trillion-dollar question, how tokenization will reshape the global order, from sovereign bonds to central banks, and what that means for the future of wealth. This is not theory. It's not someday. Tokenization is already happening. From real estate in Manhattan being sold as digital tokens, to institutional players experimenting with tokenized treasuries, the first signs of this shift are already visible. But the real impact and the tidal wave is still ahead. So buckle in, because what you're about to see is the blueprint for a new financial system. A system where value flows freely, ownership is borderless, and wealth itself is redefined. Welcome to the era of tokenization. Part 1, the liquidity revolution. For as long as finance has existed, one of its greatest challenges has been liquidity. Not all assets are created equal when it comes to how quickly they can be bought, sold, or converted into cash. A share of Apple stock can be sold in seconds, but a $20 million office building? That could take months, sometimes years, to change hands. And in that time, capital sits frozen, unavailable to flow into new opportunities. This is the bottleneck tokenization seeks to break. By digitizing real-world assets into blockchain-based tokens, ownership can be divided, transferred, and traded with the speed and simplicity of sending an email. Imagine that same $20 million office building, but instead of only being purchasable by one billionaire investor, it's represented by 20 million digital tokens, each worth $1. Suddenly, anyone, from a pension fund in Europe to a retail investor in Africa, with a smartphone, can own a fraction of that building. This is fractional ownership at scale, and it's revolutionary. It creates an entirely new layer of liquidity by enabling secondary markets where investors can buy and sell slices of traditionally illiquid assets, real estate, fine art, private equity, even infrastructure projects like bridges or renewable energy farms. All of these can be tokenized and made tradable on global digital exchanges. Consider private equity. Historically, if you invested in a private company, you were locked in for years before seeing returns, unless the company went public or was acquired. Tokenization changes that equation. With tokenized shares, you could exit earlier by selling your tokens on an open marketplace. The same applies to commercial real estate. Instead of waiting for a property to sell, investors can sell their fraction at any time, creating new flexibility and freedom. But liquidity isn't just about convenience. It is about unlocking capital that would otherwise remain stagnant. Analysts estimate that over $16 trillion in global real estate alone could become investable if tokenized. Add in private equity, commodities, and collectibles, and the figure climbs far higher. This isn't just money changing hands faster. It's entirely new pools of capital being activated, fueling innovation and growth in ways the old financial system could never support. Another key aspect is accessibility. Liquidity isn't just about speed, it's about inclusion. A Picasso painting, valued at $100 million, might sit in a museum or private vault. Technically an asset, but not one most people could ever touch. Through tokenization, that painting could be split into millions of tokens, giving art lovers, collectors, and investors worldwide a chance to own a piece. Suddenly, elite markets that were once exclusive to the ultra-rich are open to a broader audience. This democratization effect has ripple consequences. First, it expands investor participation, drawing in retail markets at scale. Second, it diversifies risk. People can spread smaller amounts across a range of assets, instead of going all in on one. And third, it forces traditional institutions to adapt. As capital starts flowing into tokenized ecosystems that don't rely on the same intermediaries. Of course, there are challenges. Tokenizing an asset doesn't make the underlying value immune to risk. If the real estate market crashes, tokenized buildings will lose value too. But what tokenization does is make the movement of that value more fluid, more transparent, and more efficient. It transforms hard-to-trade assets into something that behaves more like liquid currency. Liquidity has always been the lifeblood of financial markets. The more liquid an asset, the more attractive it is to investors. By unlocking liquidity where none existed before, tokenization doesn't just improve markets, it creates entirely new ones. And those new markets could be worth trillions. This is the first pillar of the tokenization revolution, taking the illiquid and making it liquid. But liquidity is only the beginning. In the next chapter, we'll explore how tokenization doesn't just make markets liquid. It makes them constant, global, and unstoppable, operating 24 hours a day, 7 days a week across every border on Earth. Part 2, 24/7. Global markets and efficiency in traditional finance. Time is money, literally. Markets open and close at specific hours. Trading halts for weekends and holidays, and settlement cycles drag on for days. Even in the age of high-frequency trading and global connectivity, Wall Street and other financial hubs still operate like relics of a bygone era, where bankers in suits once gathered on physical trading floors. Think about how restrictive that is. Stock markets in New York close at 4 p.m. Eastern. Tokyo's markets are silent while London is awake. If you want to move capital across borders, you're at the mercy of banking hours, wire transfer cutoffs, and intermediaries. And when you finally execute a trade, settlement doesn't happen instantly. It can take 2 business days for ownership to officially change hands in what's called T+2 settlement. That lag introduces risk, friction, and cost. Now imagine a different system, one where assets live natively on a blockchain, moving as freely as digital currency. In this system, there are no business hours. There are no delays for holidays or weekends. Tokenized assets can be bought, sold, and transferred 24 hours a day, 7 days a week, 365 days a year. This is the second pillar of tokenization, creating markets that never sleep. With assets existing as digital tokens, every investor, institution, and market participant can trade on their own schedule, across borders without waiting for banks to open. This creates not only speed, but also a level playing field for global participation. Efficiency is another critical breakthrough. Today, every trade in traditional finance passes through a maze of middlemen: brokers, clearinghouses, custodians, transfer agents. Each adds cost, delay, and the possibility of error. Blockchain replaces that with smart contracts, self-executing code that automatically settles transactions, records ownership, and distributes benefits like dividends or interest payments. What once required days of back-and-forth paperwork can now be completed in seconds. For example, imagine a tokenized corporate bond. In the traditional world, if you bought that bond, settlement would take time. and interest payments would be distributed periodically through intermediaries. In the tokenized world, once you hold that bond token, interest could flow to your wallet instantly, every second, every block, without anyone in the middle. That's programmable finance, money that works for you in real time. The benefits extend beyond just speed. Efficiency means reduced costs. By removing layers of middlemen, tokenization slashes the fees that eat into returns. This is why institutions are paying attention. For pension funds, asset managers, and banks handling billions, even shaving off a fraction of a percent in costs represents enormous savings. For retail investors, it means higher returns and fewer barriers. Global markets also mean borderless access. A tokenized asset doesn't care if you're in New York, Nairobi, or New Delhi. All that matters is that you have an internet connection and a digital wallet. This universality is what makes tokenization so disruptive. Capital can flow anywhere, anytime, without the limitations of geography or jurisdiction, and the implications go even deeper. With tokenized assets, entirely new types of financial instruments can be created. Assets can be bundled, swapped, or structured into programmable contracts that execute automatically. Think of mortgages that pay down dynamically, or investment funds that rebalance themselves on-chain. Tokenization doesn't just replicate existing financial products. It enables entirely new ones that could not exist in the old system. Of course, challenges remain. Interoperability between blockchains, security risks, and regulatory clarity are hurdles that must be addressed. But the trend is unmistakable. The infrastructure of finance is shifting from paper and intermediaries to code and networks. And as that shift accelerates, efficiency and accessibility will no longer be luxuries. They'll be expectations. Markets that never close, trades that settle instantly, assets that move at the speed of information. This is the promise of tokenization, and it's already beginning to unfold. But as revolutionary as 24/7 markets and efficiency are, they're only part of the story. The true power of tokenization isn't just about speed or cost. It's about who gets access. In the next chapter, we'll explore how tokenization isn't just a financial innovation, but a social one. A force that democratizes investment and opens doors that were once shut to all, but the wealthy few. Part 3. Democratization and financial inclusion. If liquidity and efficiency are the first benefits of tokenization, the third is perhaps the most powerful: democratization. For centuries, wealth creation has been defined by access. The wealthy and well-connected had entry to exclusive markets, private equity deals, commercial real estate, fine art, venture capital, while the majority were left with fewer, slower-growing options like savings accounts or mutual funds. Tokenization flips that model upside down. By breaking assets into digital tokens, barriers of wealth, geography, and privilege begin to fall. Suddenly, owning a slice of a Manhattan skyscraper or a renewable energy project in Europe doesn't require millions in capital or a network of lawyers and bankers. All it takes is a smartphone, an internet connection, and a few dollars. Tokenization transforms previously untouchable markets into opportunities for everyday people. Think about a young investor in Kenya who could only access local banks and perhaps limited stock exchanges. Through tokenized assets, that same investor could now buy fractions of US treasuries, German corporate bonds, or real estate in Asia. On the flip side, investors in the West could gain exposure to African infrastructure projects or Asian agricultural developments that were once too distant or inaccessible. This is financial inclusion on a global scale. It also opens the door to micro-investing. Instead of needing thousands to start, someone could begin with $10, $50, or $100, spreading it across tokenized real estate, tokenized equities, and even tokenized art. This diversification reduces risk and builds opportunity for those who would otherwise be excluded entirely. For the first time, the average person gains access to the same kinds of assets that institutional investors use to grow wealth. Democratization also has a ripple effect in communities. Imagine farmers in South America tokenizing portions of their land to raise capital directly from global investors, bypassing banks that might otherwise deny them credit. Or small startups in Southeast Asia raising funds through tokenized equity sales, giving retail investors worldwide a chance to participate in early-stage growth that was once the exclusive domain of venture capitalists. This isn't just theory. Platforms are already experimenting with tokenized real estate, private credit, and alternative assets. In 2023, a luxury hotel in Aspen was tokenized and sold in shares on a blockchain platform. Similar projects are emerging globally. proving that the model is viable and scalable. Each success story chips away at the old barriers of exclusivity. The social impact could be profound. Access to investment opportunities has historically been one of the biggest drivers of wealth inequality. The rich get richer not just because they earn more, but because they invest differently. They can access higher return, long-term and exclusive markets. Tokenization begins to level that playing field. But with inclusion comes responsibility. If millions of new retail investors gain exposure to tokenized markets, education becomes critical. Without understanding risk, diversification, and volatility, many could still find themselves on the losing end. Democratization works best when paired with transparency, clear regulations, and easy-to-understand platforms that guide investors wisely. This is where tokenization intersects with policy and regulation. Governments and institutions will need to ensure that as markets open, they do so responsibly. KYC, Know Your Customer rules, anti-fraud protections, and clear legal frameworks must evolve alongside the technology. Otherwise, the same barriers that once excluded investors could simply reappear in new forms. Still, the direction is undeniable. Tokenization is not just a financial innovation, it's a social one. It expands who gets to participate in wealth creation, giving access to those who've been left out for centuries. From New York to Nairobi, from London to Lagos, the walls of finance are crumbling. Liquidity made assets more fluid. Efficiency made them faster and cheaper. And democratization ensures they're available to all. But opening the doors isn't enough. For investors to trust and embrace tokenization, they need something more: security, transparency, and confidence in the rules of the game. That's the focus of our next chapter: how tokenization brings not only access but trust by putting transparency at the core of finance. Part 4: Transparency, Security, and Regulation. For any financial system to thrive, one element is non-negotiable: trust. Investors don't just put money into assets, they put faith into the systems that govern them. In traditional finance, that trust comes from regulators, auditors, custodians, and decades of legal precedent. But it also comes with complexity, cost, and all too often blind spots. Fraud, hidden risks, and opaque structures have brought down companies and markets before. Tokenization changes this dynamic by introducing a new foundation for trust: transparency by design. Every tokenized asset lives on a blockchain, an immutable ledger where ownership, transfers, and transaction history are permanently recorded. Once something is written to the chain, it cannot be altered or erased. This means investors can see in real time the movement of assets, the record of ownership, and even compliance activity. Compare this to traditional finance, where investors often rely on quarterly reports, third-party audits, or delayed disclosures. On-chain transparency is immediate and constant. This is more than just visibility, it's security. Blockchain systems are secured through cryptography and decentralized consensus, making them resistant to tampering. Instead of trusting a single institution to maintain records, the blockchain distributes trust across a network. Fraud becomes harder, manipulation more difficult, and accountability unavoidable. But transparency doesn't eliminate the need for regulation. In fact, it enhances it. Regulators can use blockchain systems to monitor compliance in real time. Instead of waiting for after-the-fact audits, they can see flows of capital as they happen. For governments worried about money laundering or illicit finance, this level of oversight is unprecedented. It is no wonder that regulators worldwide are beginning to experiment with blockchain for everything from bond issuance to tax collection. Still, regulation is also one of the biggest challenges facing tokenization. The question of how tokenized assets fit into existing legal frameworks remains complex. Is a tokenized share of real estate a security? How should tokenized bonds be classified across borders? These questions aren't theoretical. They determine how quickly institutions can scale adoption. This is where ISO 2022 compliant blockchains like the XRP Ledger, Stellar, and XDC come into play. These networks are designed to bridge the old financial system with the new, supporting standardized messaging formats that banks and payment systems already use. By aligning with existing global standards, they provide regulators and institutions a smoother pathway to adoption. They act as the translation layer between traditional finance, TradFi, and decentralized finance, DeFi. Transparency also builds confidence for investors themselves. For retail participants, Being able to verify ownership directly on-chain provides reassurance. For institutions, on-chain settlement reduces counterparty risk. For governments, programmable compliance means rules can be coded directly into assets. For example, only allowing tokens to transfer between verified wallets. This blend of transparency, automation, and accountability could make tokenized markets safer than the systems they replace. Of course, challenges remain. No system is invulnerable. Hacks, smart contract bugs, and poor governance have plagued parts of the crypto world. The lesson is clear. Technology must be paired with rigorous oversight, insurance mechanisms, and clear standards. But as institutions step into the space, best practices are beginning to form. Custody providers, regulated exchanges, and compliant platforms are building the infrastructure that will make tokenization robust enough for trillions in assets. In the end, transparency and regulation are not opposing forces, and they are partners. Tokenization gives regulators better tools than ever before, while giving investors the clarity and security they need to participate. When liquidity and democratization open the doors, transparency and regulation provide the guardrails. And once those guardrails are in place, tokenization will have everything it needs to scale into the backbone of global finance. Which brings us to the final chapter, the macro impact. How will all of this, trillions in unlocked liquidity, global markets that never close, democratized access, and transparent systems, reshape the world order of finance? The answer could redefine wealth, power, and opportunity for decades to come. Part 5. Macro impact. The new global financial order. When you step back and look at the big picture, the implications of tokenization go far beyond individual investors, markets, or even industries. This isn't just a new financial tool. It is a reordering of the global system, a new foundation for how wealth flows, how power is distributed, and how nations interact. At the sovereign level, tokenization has the potential to reshape government finance. Imagine U.S. treasuries issued natively as blockchain tokens. Investors around the world could buy fractions of those bonds instantly, 24/7, without relying on intermediaries. Interest payments could be programmed to flow directly into wallets in real time. The same could apply to corporate bonds, municipal infrastructure projects, or even international development funds. Tokenization makes capital more direct, more global, and more efficient. Central banks are also watching closely. Many are already experimenting with central bank digital currencies, CBDCs. Pair CBDCs with tokenized assets, and suddenly you have a financial ecosystem where money and value move seamlessly on the same rails. A central bank could issue digital dollars, while investors trade tokenized equities or bonds alongside them, all on interoperable blockchain networks. This convergence could redefine monetary policy and global capital markets. And then there's the question of scale. Analysts project that by 2030, as much as $16 to $20 trillion in assets could be tokenized. Others argue the figure could climb to $100 trillion when factoring in real estate, private markets, and commodities. That is not just growth. That is a migration of value on a scale rivaling the rise of the internet itself. The geopolitical impact could be enormous. Traditional financial hubs like New York, London, and Tokyo may see competition from blockchain-based ecosystems that aren't tied to geography. Capital will no longer be bound by clearinghouses, custodians, or national market hours. Instead, it will flow to wherever liquidity, compliance, and efficiency are strongest. Nations that adopt tokenization early could attract unprecedented levels of investment, while those that resist may find capital flowing elsewhere. For investors, this new world offers opportunity and challenge. Opportunity because tokenization unlocks access to markets and assets once out of reach. Challenge because the speed and fluidity of global capital flows may amplify volatility. The financial system will become more dynamic, but also more complex, requiring new tools and strategies to navigate. One of the most profound changes may come in ownership itself. In a tokenized world, owning assets doesn't require physical custody or paper certificates. It means holding a digital key that proves your share of something larger. That simple shift, from paper to digital, from centralized registries to decentralized ledgers, redefines the very concept of wealth. Ownership becomes more portable, more divisible, and more liquid than ever before. Critics will argue that technology alone cannot erase centuries of inequality or solve every market inefficiency. And they're right. Tokenization is not a silver bullet, but it is a catalyst, a tool that, if paired with wise governance, can push finance into a more open, inclusive, and efficient era. The decisions made by regulators, institutions, and innovators in the coming years will determine whether this promise is fully realized. Still, the direction of travel is clear. Finance is becoming faster, more global, more inclusive, and more transparent. The walls that once protected wealth for the few are crumbling. A new system is being built, one token at a time. The liquidity revolution unlocked capital. The rise of 24/7 markets removed barriers of time and place. Democratization opened doors to billions of new investors. Transparency and regulation laid the guardrails for trust. And together, these forces point to a future where tokenization is not just a feature of finance. It is finance. This is the macro impact of tokenization, the re-engineering of global wealth flows. A shift so vast that, like the internet before it, the world will look back and wonder how finance ever operated without it. The trillion-dollar shift, we've reached the end of this journey, but in truth, it's only the beginning. The tokenization of real-world assets isn't some far-off dream. It's unfolding right now. Trillions of dollars in value are being reimagined, rebuilt, and released onto blockchain networks. The way we invest, trade, and even think about ownership is being rewritten before our eyes. From unlocking liquidity in once frozen markets, to creating financial systems that run 24/7 across borders, to democratizing access and embedding transparency into every transaction, tokenization is more than an upgrade. It's the foundation of a new financial era. The question isn't whether this shift will happen. The question is whether you'll be prepared when it does. Because those who understand it early will have the chance to ride one of the greatest financial transformations in history. And those who don't, they'll be left asking how the world changed without them noticing. Here at LTL Productions, our mission is simple: to help you see the future before it arrives. To break down the noise, to explain the shifts that matter, and to show you where opportunity lies in the chaos of change. So if you found value in this deep dive, don't just click away. Hit that subscribe button right now. Join a growing community that refuses to be caught off guard. Share this video with someone who still thinks finance will look the same tomorrow as it does today. Because it won't. Tokenization is coming. The trillion-dollar shift is already underway, and together we're going to follow it every step of the way. Subscribe to LTL Productions. Don't just watch the future, be part of it.